Hello and welcome back to the Modern Money YouTube channel. So as many of you already know, today the Federal Reserve made their decision on the Fed funds interest rate and made the decision to raise it by 75 basis points, bringing us up to the 1.5 to 1.75 Fed funds rate. Now, just like I outlined earlier when I had made a little bit of a video this morning kind of talking about what my thoughts were going into the Fed interest rate decision, a 0.75 did turn out to probably be the best case for the stock market. The 0.75 signaled that basically the Fed is willing to fight inflation and that they're going to do what they can to try and bring inflation down. People were fearful that if we got a 1% hike total or a 100 basis point hike, that people would become more nervous or that we could get a shock sell-off in stocks, which we probably would have had. And like I had said, I think that we would have gotten a bigger shock and then a little bit of a leveling. And if we would have got a 50 basis point hike, in my opinion, then we would have probably just had more slow bleeding, while the economy and most investors on Wall Street would have been thinking that the Fed is out of their mind and not doing anything to actually tackle inflation. So with this, people are asking, well, where does the stock market go from here? And in my opinion, the best place to look is actually the summary of economic projections that we are given by the Fed today. All right, so now on screen, as you guys can see, I actually have the SEP or summary of economic projections that we got from the Federal Reserve today on screen, so you guys can all kind of follow along with me and we can mark this up and kind of talk about some different parts of this report, so that way you understand really where I'm getting this information from, that I'm basing where the market might go from here. So the first thing that was super important in this report was right here, this actual real GDP projection. Alrighty, so basically what we were wondering was, were they going to revise this down? And unfortunately, this has been revised down right here. As we can see, it has now gone to a 1.7 rather than the 2.8 that they had projected in March. Now, in my opinion, I still feel like 1.7 might be a little bit optimistic, but they are lowering GDP estimates, which means that technically they are seeing more of a slowdown in whatever data they are getting. On top of this, we're also seeing them starting to raise unemployment rates for their projections for 2022, and they are actually projecting them to keep on rising all the way out till 2024. Now, I don't want to be too worried about this yet, because a 3.7, 3.9, or even a 4.1% of unemployment rate would actually not be that bad. In fact, relatively, historically speaking, that is actually still a pretty dang tight labor market, but still something to be concerned about, considering they're raising their projections for the unemployment at the same time as they're lowering GDP measurements, which could signal to some that they might be seeing some signs of a possible recession brewing, but at the same time, until they start to actually give us a negative number here in the GDP or something closer to the zero, then they're really not admitting that there is anything like that coming on the horizon. Now, on top of this down here, we can see that the PCE inflation numbers also have been edging up on both core and total item expenditures. Unfortunately, this is not such a hot thing as well. But truthfully, a little bit of hotter inflation numbers are kind of in a way also a good thing, as it's going to force the Fed to start messing with this guy right here, the Fed funds rates, which actually, in my opinion, this is a good thing from this report. Now, if you would have watched my video this morning, you would understand that at that Fed funds rate, I was actually a little bit nervous at them coming in with a 3.5 here on the median, or having somebody over here in the range column have the high range come in at 4. Now, the reason why that would have been a little bit spooky is at the time of this report coming out, the market was pricing in at basically a 3.5 end of the year Fed funds rate. So I knew that anything that would come in above that could actually start to, spark some fear in markets. And of course, literally 0.1 below what I said would have been the freak out point in both categories, on both the high range and on the median, is what came in. So in my opinion, on the Fed funds rate at least, it was actually a good thing it came in right here as far as market sentiment. Not saying that it's a good thing that they're only planning to go to 3.4, because truthfully, in my opinion, that might not be enough to combat inflation. Now, one thing that we do get out of this report that is actually good, swapping over to the good, was that we kind of have an idea of when the Fed might pivot as far as actual policy making goes. And right here we can see they're expecting us to be at 3.4 by the end of this year, 3.8 by the end of 2023, but then look, 2024 comes along and we get a 3.4. So somewhere between the beginning of 2024 and the end of 2024, at least right now, the Fed is expecting that they could pivot and start to reduce interest rates again. And then of course, longer run right here, we can see that that goes back down to 2.5 right there. Okay, so moving on to this report, the other important part of this thing is this dot plot right here. And this gives us a really good idea of where actual Fed members sit as far as where they feel that the actual Fed funds rate should be on different years. So down here we can see 2022, 2023, and 2024. And then basically each one of these dots represents an actual participant or voting member of the FOMC and where they would vote that the rate should be by the end of each said year, right? So as we can see, it's pretty unanimous that we are expecting to be right here around that 3.5 area with most participants. But also another interesting thing to kind of note is that there are some that get up as high as that 3.9, like we could see back here on the range summary right there, right? So why is that important? So the reason why that is important is because what we've been seeing over time with more and more of these summary of economic projections is basically these dots have been moving steadily up this chart as inflation persists. So if we continue to see inflation persisting, it would not be unlikely to maybe start seeing some more dots up in this area, maybe even a couple start sneaking up into here. And then before we might start getting projections of actually having over a 4% interest rate from the Fed by the end of this year. And of course, as we all know, even from just this week alone, when we start to get more revisions up in our expectations at the end of the year rate, then inevitably the stock market goes down. So it is definitely something to be looking at. But what can we actually extrapolate from this report to give us a little bit of some forward-looking guidance for what the Fed may do and what markets may do here in the future? Well, in my opinion, we can safely look at this median expectation right here, the Fed's funds rate, and go, okay, well the median was 3.4, but because things run in ranges, that basically means that we'd be in the range of 3.25 to 3.5, or rather 3.5 to 3.75, my bad. And so because of that, what we know is we're still 1.75% away from even the current projected funds rate for the end of the year. So that leaves us with a couple of options on how we could get there. Right now, what the market is currently pricing in is they're expecting a 75 basis point hike next month, a 50 after that, and then 225s to end off the year. But other things that could happen are going to be maybe, 350s and then a 25 basis point to end off the year. So how do we know which one of these is actually going to happen? Well, believe it or not, Jerome told us right in his speech today that it's going to be entirely dependent on what economic releases they get and what data that they get. So that way they can, as they call it, nimbly or quickly adjust policy on the run to try and combat inflation to the best of their abilities without overstepping and possibly forcing a recession. So what does that mean for the market? It means that the market's going to continue to look at the exact same data that we've been looking at now for the last couple of months, trying to keep ourselves in line with where the Fed might be going next. And as we've known from the last couple of months, that's not necessarily the best thing for the stock market. It probably guarantees us that there's going to be more volatility around PCE reports, CPI reports, consumer data, and inflation expectation data releases. So that is one thing to be considering as we start dollar cost averaging into this market, is that, hey, possibly we might get more deals around the weeks of these big data releases. So make sure that you're subscribed to the channel, as I will be updating everybody when these big data releases are going to be coming out. So you guys are going to be the first to know when these big volatility weeks might be coming up, and you can be taking advantage of possible stock opportunities. Really, what the Fed has outlined to us that they are looking for to claim victory against said inflation is a couple of month-over-month reports saying that, yeah, inflation is actually on its way down. Once we start to get maybe 3 or 4 of these month-over-month reports that show a decline in the growth rate of inflation, I think it's going to be safe to say that we are on our way to the Fed pivoting their stance, which could mean a bull run in the stock market. So with all this crazy stuff being said, what is my strategy going forward from here in the stock market and with investing? Well, I'm definitely not taking things too fast, and my strategy is the same as what I had said a couple of days ago in my past videos. I'm going to just keep on dollar cost averaging into my favorite, highest conviction stocks that I do enjoy. For me, that's Tesla, Nvidia, AMD, and Apple so far. I'm still on the hunt for more companies. There's plenty of great deals out there on the market right now, but I like to go in and actually do a little bit of a fundamental analysis on each one of these companies before I actually start to put money into them. But as of right now, those 4 companies are where I'm allocating most of my capital, and I am definitely a little bit heavy in Tesla, as its peg rates are definitely the most attractive. Well, alrighty guys, that's me summing up the Fed interest rate decision today, as well as the summary of economic projections. Truth be told, it was probably one of the better things that could have happened for the market today, so I guess my portfolio at least is happy for that, but we'll see what happens going forward. Another big announcement that I wanted to make is I'm going to be starting a new series actually on the channel here really soon, and I'm trying to decide exactly how much money I want to put into this series. Basically, this series is going to be me investing a set amount of money and allowing you guys to watch me do so and publicly sharing it with all of you guys on YouTube while I invest. But I am still trying to decide, do I want to go in on this series with $10,000, $20,000, $30,000? Let me know down below in the comments, how much money do you want to watch me trade here on the channel in a public account that you guys can all be a part of and enjoy watching as well. Anyway, leave me that comment down below letting me know how much I should do. Also, don't forget to hit that subscribe button and like button down below, as it does help out the channel tremendously. Until next video, peace.